Hello and good afternoon, everyone. I am Mangesh from Corporate Communication team, and on behalf of CareEdge, I welcome you to our today's discussion on Indian road sector, navigating a smooth journey, and sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today, Gaurav Malhotra, CFO and Head HAM M&A, Cube Highways and Transportation Asset Advisors Private Limited, Hardik Agarwal, Director, Dineshchandra R. Agrawal, Infracon Private Limited, Paresh Mehta, CFO, Ashoka Buildcon Limited, Siba Narayan Nayak, President Corporate Affairs and Development, GR Infraprojects Limited. This session will be moderated by Rajeshri Murkute, Senior Director at CareEdge Ratings. We will commence this session with a presentation by Maulesh Desai, Director at CareEdge Ratings. This will be followed by a panel discussion. We will be having Q&A session with the audience at the end of our discussion. In case of questions, you are requested to key in your panel. Now, may I invite Maulesh to make presentation?
Thank you, Mangesh. Good afternoon and warm welcome to our esteemed panelists and dear participants in today's webinar, Indian Road Sector, Navigating a Smooth Journey. In today's session, we shall cover Care Rating study on NHAI HAM projects, impact of HAM projects on road developers, outlook on NH awards and execution, and finally, we shall also look at the outlook on toll growth and key takeaways. So let's begin the session with the Care Rating study on NHAI HAM projects. Care Rating has studied 235 NHAI HAM projects with aggregate length of 10,000 km, bid project cost of 2,74,000 crore and debt of 75,000 crore. These projects are awarded to unique 42 sponsors from FY16 to FY22. HAM projects have strong linkages with the sponsors in project execution as well as for funding of the equity commitment. Therefore, Care Ratings has bifurcated the sponsors into strong, moderate, and weak category basis their operational and financial performance. As seen in the center of the slide, share of strong, moderate, and weak sponsor constitute 59%, 36%, and 5% respectively. Now let's glance at the project in the right side of the chart. As seen in the pie chart, 31% of this BPC, constituting 84,000 crore of the projects, have already achieved COD or PCOD, while 20 projects worth 29% BPC are awaiting appointed date. For projects worth 40% are under construction with aggregate bid project cost of 1,11,000 crore. So let's begin with the analysis of the operational HAM portfolio. As seen earlier, projects worth rupees 84,000 crore have already achieved PCOD, while projects worth rupees 16,000 crore are expected to achieve PCOD by March 23. Therefore, looking at the operational portfolio in the right side of the slide, with the BPC of 1 lakh crore and debt of 41,000 crore, it is inferred that 87% of this debt of 41,000 crore is expected to have a strong cash flow resilience. Drivers for strong cash flow resilience are favorable completion cost at 110 to 130% above BPC due to inflation indexation benefit, low project leverage marked by debt by BPC of less than or equal to 40%, and repo linked term debt structure for some of the projects. Care Ratings expects that these projects have a prospects to raise additional 9,000 to 11,000 crore through top-up loan, stake sale, and InvIT. In fact, some momentum was also visible in FY21 and FY22. Now moving to the under construction portfolio of 1,11,000 crore. As seen in the left side of the chart, projects of moving ahead or timely, nascent projects in the nascent stage, and projects progressing with delays constitute almost equal proportion in the pie. Analyzing the delays project and linking it to the stronger into sponsor category, it is inferred that 90% of the projects awarded to the weaker sponsor are progressing with the delays, while only 9% of the projects awarded to the strong sponsor are progressing with the delays. Therefore, strong sponsor with the demonstrated execution capabilities are better placed to tackle execution woes, while weak sponsor drag execution. Typically, construction period of the HAM project ranges from 24 months to 30 months, and factoring the COVID EOT of 6 months, it is believed that projects awarded prior to March 2020 should either have been achieved COD or under advanced stage of completion. Therefore, CARE Rating has taken a stock of projects awarded prior to March 2020 with aggregate BPC of 1,22,000 crore. It is inferred from the pie on the left chart that 81% of these projects have already achieved either COD or PCOD or progressing timely under advanced stage, while 19% projects are progressing with the delays. Linking this delayed project again to the sponsor profile, it is inferred that 42% of the BPC attributed to strong and moderate sponsor, inferring moderate execution risk. Execution challenges are attributed to the structural complexity and delay in land acquisition in these projects. Issuance of partial COD and descoping of unavailable land are the mitigating steps for these projects. While 58% of the projects awarded to weaker sponsor are progressing with the delay, indicating very high execution risk. Correspondingly, CARE Ratings estimate that the debt of rupees 6,000 crore is at risk. Termination as well as harmonious substitution of the sponsor are some of the risk mitigating mechanism. Before we move ahead to the status of the projects awarded after March 2020, let's look at one important development happened in March 20, that is relaxation in bidding criteria. NHAI has relaxed bidding criteria. NHAI has relaxed the criteria for the net worth, broadened the experience criteria, and waived performance BG requirement. This has intensified competition in the sector, marked by the maximum bidder as seen in the right side of the chart has increased from 10 in FY20 to 24 in FY22, while median bidder has increased from 5 in FY20 to 12 in FY22. This is mainly on account of increased participation from mid-sized contractor having moderate credit profile. The same has also been corroborated from the slide, wherein the share of moderate to weak sponsor has increased from 22% in projects awarded prior March 2020 to 40% in projects awarded after 2020. Correspondingly, share of strong sponsor shrunk from 78% to 60%. In view of increased participation from moderate sponsor and intense competition, CARE Rating has also analyzed the projects awarded after March 2020. Looking at the center of the slide, for the portfolio of the projects awarded after FY20, it is inferred that the projects with projects with BPC of 52%. Projects with a 52% of BPC are awaiting appointed date. Out of these, projects worth rupees 26,000 crore are awaiting appointed date for over 1 year. This has heightened the termination as well as rebidding risk for the sector. Moving again to the center of the slide, 26% of the BPC in this portfolio are under nascent stage, out of which 33% are awarded to the moderate sponsor as seen in the right side of the slide. Therefore, CARE Rating estimates elevated execution risk in these projects of rupees 13,000 crore, especially awarded to the moderate sponsor. It is on account of the relatively stricter sanction terms and increase in commodity price post bidding. Moreover, strong sponsors have also forayed into the newer geography and secured structurally complex projects in light of intensified competition. Therefore, timely completion of the projects awarded post March 2020 is crucial from the credit perspective. In light of the elevated execution risk, we have also analyzed the funding risk, and it is inferred that the pending equity commitment for the HAM project is estimated at rupees 15,000 crore. Linking this equity commitment to the sponsor profile, it is inferred that the funding risk is relatively lower for the strong sponsor, marked by equity commitment at 25% of their net worth, and pending equity commitment is at 1.5x of their existing cash accrual against the construction period of 2 years. However, the funding risk is relatively higher for the moderate sponsor, marked by the impending equity commitment is 77% of net worth and 3.7x of their existing cash accrual against the construction period of 2 years. The funding risk further accentuated in case of moderate sponsor having portfolio of under construction projects and having a relatively stricter sanction terms. In a bid to tackle the aggressive bidding, especially in the O&M annuity, NHAI has also modified the concession agreement. Earlier, the bidding criteria was basis the NPV of the bid project cost and O&M annuity. Under revised model concession agreement, it stands revised, and now bid shall be evaluated only on the basis of the bid project cost. Earlier, O&M annuities were payable by NHAI basis bid. Under revised clause, authority shall pay the O&M annuity in fixed percentage defined for each year. So this is the change. However, Care Rating estimates that the change in the model concession agreement shall have a limited impact in curbing the competitive intensity. However, at the same time, competitive intensity has softened to an extent in FY23, mainly due to limited participation from moderate sponsors. Moving to the second part of the presentation, that is impact of HAM projects on the credit profile of the developers. Care Rating has also studied the sponsors who have a portfolio of HAM projects and the sponsors who are executing those projects on their own on EPC basis. As inferred from the slide, the total operating income grew at healthy rate of 19% from FY20 to FY22, as reflected from growth in income of 24,500 crore in FY20 to 34,500 crore in FY22. Care Rating expects growth in total operating income by 15% in FY23. Nevertheless, PBRDT margins steadily declined from 16.43% in FY20 to 14.03% in FY22 due to disproportionate hike in commodity prices over the WPI and CPI. Care Ratings expect decline in margin by again 70 basis points in FY23, and it is expected to remain range bound at 13.3% in the medium term, mainly due to elevated competition. Therefore, heightened competition is expected to negate the benefit of softening in commodity prices. Moving to the debt coverage and leverage indicators of the major sponsor, it is inferred from the left side of the slide that the total debt by EBITDA and interest coverage both are healthy in FY22. Even if you look at the TOL by TNW on the right side of the slide, it increased marginally from 1.05, but it continued to remain comfortable level at 1.24 times as on 31st March 2022. Hence, healthy balance sheet indicators are expected to provide some financial flexibility, especially to moderate sponsors. Moving to the third part of the presentation on outlook on NH project award and execution. Basis the study of the HAM projects, Care Ratings infer that the project award and execution are expected to slow down in FY23. Care Rating estimates that the project award is expected to slow down by 10% from FY22 level, and pace of construction is expected to slow down from 29 km per day in FY22 to 27 km per day in FY23. Increase in share of moderate sponsor, awaiting appointed date for large proportion of projects, and limited debt raising appetite of NHAI are the prominent reason for slowdown in award and execution according to Care Ratings. Moving to the final section on outlook on toll growth. As seen in the right side of the chart, toll collection degrew only by 5.5% in FY21 despite COVID. Toll collection further grew by 16% in FY22 on a low base of 21. Increase in penetration of FASTag and increase in freight traffic due to thrust on road developments and higher e-commerce activity are the prominent reason for the growth in toll collection. CARE Rating estimates that the toll collection shall grow at a healthy rate of 25% in FY23 due to higher WPI and receding impact of COVID-19. As seen in the left side of the chart, traffic recovery is estimated to reach at 1.08x of pre-COVID levels in FY23 over FY19. However, in the long term, commencement of dedicated freight corridor and alternate routes like DME are the major challenges for the toll road sector. Moving to the last part of key takeaways. Beginning with the operational HAM projects. Operational HAM projects with aggregate debt of 36,000 crore are expected to exhibit strong cash flow resilience. However, increase in bank rate, limited investor appetite, and option of top-up loan are expected to dampen stake sale prospects of HAM projects. Moving to the under construction HAM portfolio awarded to prior 2020, CARE Rating infer that strong sponsors have outperformed, while debt of 6,000 crore is at risk, mainly due to the weakened credit profile of the sponsor. Coming to the projects awarded after March 2020, it is inferred that the projects of rupees 26,000 crore is at the risk of termination, mainly due to delay in receipt of appointed date over 1 year. CARE Rating also estimates that the execution challenges has elevated for the sector, especially for the moderate sponsor, with estimated equity commitment of 3.7x of their current cash accrual. Coming to the impact of HAM projects on the road developer, CARE Rating expects healthy growth in TOI, albeit with decline in EBITDA margin by 70 basis points and continue to remain at moderate level at 13.3% in the medium term due to competitive bidding. And moving to the last section of toll road projects, CARE Rating estimate healthy toll growth of 25% for FY23 and 11% for FY24 due to high WPI benefits, and traffic recovery to surpass pre-COVID levels in FY23 and likely to touch 1.0x of FY19. With this, we shall end our presentation. Now I request Mangesh to take it forward. Thank you.
Thank you, Maulesh. Now, may I invite Rajeshri to take over this session, please? Rajeshri is a senior director and heads the infrastructure vertical at CareEdge Ratings. She has 20 years of industry experience, specializing in corporate credit ratings with a focus on the infrastructure sector. At CareEdge Ratings, she has led various rating teams across diverse sectors within infrastructure and corporate verticals. Over to you, Rajeshri.
Thank you, Mangesh, for the quick introduction, and Maulesh for the wonderful deck presentation. Good evening and a very warm welcome to one and all who joined us for today's webinar on Indian road sector. We have today with us some of the best minds from the industry to discuss threadbare on this subject and place their perspectives before us. So I'd like to introduce you to our esteemed panelists in alphabetical order. Our first panelist is Mr. Gaurav Malhotra. Gaurav is CFO and Head M&A at Cube Highways and Transportation Asset Advisors Private Limited. Cube Highways is an investment platform located out of Singapore with a mandate of investing in transportation projects in the country. And backed by marquee investors, Cube Highways is the largest operator of road owns and operates a portfolio of about 16 road projects in the country. As part of his role at Cube Highways, he performs dual responsibility of leading both project finance activities and HAM space for Cube Highways. And he's been instrumental in closing an equity deal with the hybrid annuity space to acquire a portfolio of 8 HAM projects. Prior to his current stint at Cube, Gaurav was an investment banker in the Indian private banking space and holds an MBA degree from NITIE Mumbai and BTech from NIT Durgapur. Welcome, Gaurav. Our next panelist is Mr. Hardik Agrawal. Mr. Agrawal is director at Dineshchandra Agrawal Infracon Private Limited, primarily handling the company's business development and investment activities. He has spearheaded a successful set of PPP projects in roads and transport infrastructure. He serves as the chairman for FICCI's Infra Committee for the Gujarat State Council and is also a member of the National Executive Committee of FICCI. Mr. Agrawal is an active participant of the Rail Division at CII and holds a BS in Construction Management combined with Law, Business Studies and Architecture and Urban Policy from the prestigious New York University. Welcome, Mr. Agrawal. Our third panelist for today's session is Mr. Paresh Mehta. He's the CFO of Ashoka Buildcon Limited. He heads finance, taxation, and accounting divisions of the group. A CA with more than 30 years of experience across various corporates and sectors, Mr. Mehta has been associated with Ashoka Buildcon Group for more than 20 years and has played an instrumental role in the execution of recent stake sale and M&A deals. Mr. Mehta is felicitated by Siba as one of India's most influential CFOs. Welcome, Mr. Mehta.
Thank you.
And now let me introduce you to our fourth panelist, Mr. Siba Narayan Nayak. He is the President, Corporate Affairs and Development at GR Infraprojects Limited and leads the GRIL's diversification initiation to other business areas. He's previously worked with NHAI as CGM in finance function and has handled a gamut of finance and project-related activities. He's pioneered the maiden issuance of overseas rupee-denominated masala bonds, which are listed on LSE, and also instrumental to bring in a host of policy initiation changes, including amendment to various model concession agreements. Mr. Nayak holds over 38 years of experience across various functions, including finance, accounts, resource mobilization, project finance, with specialized exposure in the infra sector, more particularly in roads, power, and real estate. Mr. Nayak is a member of the Institute of Cost Accounts of India, the Institute of Company Secretaries of India, and the Institute of Public Auditors of India. Warm welcome, Mr. Nayak. So now for a few preliminary remarks on today's theme. So the Indian road sector is going through an extremely dynamic phase with vast opportunities to scale up, necessitating major investments to build and upgrade the existing infrastructure. So in a bid to monetize these opportunities, the governing authorities as well as private participants, they all have been working very closely over decades. Yet the challenges have only turned perhaps more steep with the onset of pandemic and especially multiple waves in last 2 years. Therefore, from infrastructure creation perspective, it becomes imperative to understand how are these challenges unfolding and tackled at each level. And because of so many questions and thoughts which are hovering on these key issues pertaining to the sector and also presented by my colleague Maulesh, especially pertaining to the HAM segment and road developers, we felt it appropriate to hold this webinar and get our industry experts to deliberate on these ponderables. These are also important issues for us as a rating agency, as we have to continuously assess the credit risk under all these developments. I would not like to impose myself on the answers to these questions, and I'm sure we'll have the experts to tell us how they think this will work out. So my first question, that's to you, Mr. Mehta. As mentioned in the presentation, if you recall, so the HAM projects worth aggregate BPC of close to about 7,300 crores. These were awarded prior to 2020, March 2020, and belonging to strong sponsor, but they are yet facing delays. So according to you, what are the critical challenges which are still persisting despite so many reform initiatives which have been undertaken by NHAI?
Yeah, I do agree that in spite of strong sponsors for the projects continue to, some of the projects, I don't see, it's a small subset of projects which are still getting, not still getting completed. And we really appreciate NHI's efforts to streamline the COD process, wherein descoping is a great help, and the process laid down is quite elaborate as far as the central office of NHA is concerned. But when we go to actual implementation of this descoping, there are certain challenges which the developer faces when it goes to ground level classification of the descoping areas, how they are going to be completed. There are various challenges of parts and pieces of the land not being available, being descoped, but the O&M challenges continues to be interlinked. So this typically continues to be a challenge in spite of the de-scoping method being put in place. A couple of more challenges are that in spite of, apart from de-scoping, there are certain de-linking issues also. And in de-linking, what happens is there is an obligation of the developer to complete the project whenever the land is made available. That time, certain differences on cost incurred, in spite of escalation being offered, becomes a great challenge for the developer to align with his expected IRRs, which he was trying to perceive. Also, when there is a substantial de-scoping happening in a project, the debt equity, what happens is equity gets invested first. Debt does not get picked up because the project is not over, which leads to a change in the debt equity structure, which typically impacts the equity IRR substantially. Also, there are smaller issues like independent engineers' fees. They do not get adjusted for revised BPC. Small issues, they keep on nagging a developer. But I believe end of the day, once the COD is done, I think so a developer is happier that the annuity is visible and the banker is happier that the annuity is visible. So in spite of all this, I still believe that de-scoping has helped and other smaller issues will get sorted out as time goes by.
Okay, understood. So prima facie, what you're saying is while the reforms and initiatives are definitely initiated, but in practice and on ground, they yet to be implemented more smoothly. On the same lines, I would come to you, Mr. Nayak, because you've had a mixed experience both as a regulator and now as a developer. What, according to you, is the biggest gap which remains to be plugged? Mr. Nayak?
You're in mute, sir.
Yeah, can I know what is the gap you are referring to?
So what we are referring to is, there have been multiple reform initiatives which anyways a regulator has been taking time and again so as to address the challenges which the developers are facing. Yet we see that even when we looked at the presentation also, there were projects which are belonging to strong sponsors and they too continue to face delays. So you're trying to just, kind of understand what according to you is still left to be done and what are the critical challenges and the gaps are which are still remaining.
Okay. Yeah, let me explain on two things. One is that of practical challenges what is coming as far as the authority is concerned, and there are a set of challenges also applicable equally to the concessionaires, right? As far as critical challenges still remain, see there are lot many constitutional changes has been done during last 2 to 3 years. That includes this benchmarking of interest rate, then O&M cost has to be deleted from the bidding parameters, then change in ownership is changed, then shifting of obstructing utilities has been put on the owners of the concessionaires. Then there is a dispute resolution. So this is preliminary. These three some things has been put out in the concession agreements. But as far as critical areas are concerned, still it remains the same, almost what it used to be earlier. The first and foremost is what I said is the project preparedness. Once again, in spite of the fact that the concession agreement has been changed to that extent to put the this main carriageway into prominence, right? But there are still project preparedness issues are there. Even if it is told on the paper that we have adequate, land parcels available for continuous stretch of construction, still it is missing on the field. Then other things comes in is that one is that coordination between the stakeholders. When I am talking about the stakeholders means, whether it is NHI, whether it is the independent engineer, whether it is the banks, or for that matter, for a pure developer, it is the EPC contractor. So once the project is in the place, all the stakeholders has to be in same place, in the same mental, wavelength. So that is somehow it is missing in many cases, and particularly for the, weaker sponsors, what we are referring to as a critical one. What is happening for these weak sponsors is that there is a lack of coordination between the entire of the four. There is a apprehension from the NHI, okay, in spite of the fact that they have gone for the right kind of qualification as per the bidding criteria. The banks has taken time to give the financial closure with so much of conditions. Then probably, as far as the EPC margins are concerned, they themselves are not very comfortable because of aggressive bidding in the area of high competitions. Then another thing is that this, sometime at some places, even the project is put for construction, the local issues crop up. So probably that is one of the area where we do not address properly. Once this appointed date is cleared, in many cases, local protesters come off to add some additional facilities to the road. So that is one of the area. And of course, some of the areas what I will refer is the force majeure clauses also. We are not addressing it properly. So these are the critical areas probably we have to put together and address. So I'm not talking about whether it is really to be addressed by NHI or by the concessionaires or by the bankers. In fact, I would say at some point of time, even the bankers have a greater role to play as far as the the completion of project is concerned. Why I'm telling is that there is a lack of project monitoring. So banks, though they have been very proactive these days, still lacks that kind of particular expertise in that field. Neither they are resorting to some good consultants to be appointed on a regular basis. That is not coming off as it should have been. So what I refer to is that these are the gaps probably we have to address at any point of time to to avoid the delay in the projects. Thank you.
Okay, got it. So I think very simply put, the broad points that you've highlighted is on the ROW, on the contiguous land issues, coordination between the stakeholders, local issues which still continue to crop up, and you're saying that the banks also need to come forward and improve their project monitoring systems.
I believe one more point can be added to it. This inflexibility stand taken by most of the shareholders, I should say, except concessionaire. Take a very hard stand. This independent engineers takes a very hard stand. Even NHI official, for that matter, takes a very rigid stand on many issues. So some kind of flexibility needs to be built in to have a better effect on the projects.
Sure, definitely, that's extremely important. So coming to you, Gaurav, just wanted to understand now. Undoubtedly, we are in interesting times. There have been multiple events which are continuously unfolding, be it sequels of the pandemic or even geopolitical issues and whatnot. Yet, traffic recovery per se has been fairly prompt from all of these events, right? In fact, in CARE Ratings credit ratio that we compute for the infra companies at the end of H1 FY23, that also was pretty strong at 2.6 times. Though it was a slight moderation this half year. We also see that the global turmoil condition, they continue to still remain a big worry. So with US Fed rates still continuing to increase, do you see that the private equity funds which are flowing to India, especially towards road infra companies, are they likely to dry up, and are we going to see any kind of less money chasing more assets, that kind of a phenomenon?
Yes, I think it's a great point. Internally, we've been discussing about this, and we've been talking to our investors on this very point. I think what is clearly is highlighted to everyone, whoever we talk to globally, is that India remains a very bright spot for everyone to come in and invest. I think even if you look at from an exchange rate perspective, this is the most stable economy in the Asia Pacific region. And if you look at the equity market, they are doing the best across the Asia Pacific market from an emerging market standpoint. So I think it's very clearly evident that not only the public markets, but the private markets are also quite healthy at this point in time. The only place where growth is visible to people is actually the Indian subcontinent, and primarily India. Now, the other thing which is supporting all of this is a good track record in infra. I think the government of India has done a great job, and it has done a great job in creating regulatory certainty in terms of what has been laid out. I think we were discussing about the gaps. I think those are areas, clearly the areas of improvement. But if you look at the fundamental pieces of the concession agreements that we have today for HAM, the fact that 80%, at least if not 80 but 70% of the land is there. I have not seen if the work is completed, the PCOD is delayed. Obviously, T-scoping issues are there, as Mr. Mehta pointed out. But if you look at the track record of what has happened over the last 6-7 years, not only in the HAM sector but also overall in the road sector, people who have invested money, they have made returns out of it. So I think, given the fact that this is a good bright spot, India as a whole is a good bright spot. There is regulatory uncertainty. Infra over the last 7-8 years has done quite well. People have made money in here. I think this is clearly a good going for us. If, let's say, we keep our act together, I at least feel that the next 15-20 years are going to be for infra sector going forward. There's still a long runway ahead of all of us. Yeah.
Okay, great. So it sounds indeed pretty reassuring. 15-20 years saying that, India is still on a bright spot, and largely because of the supportive regulatory framework that you've pointed out, that's pretty reassuring. Mr. Agrawal, my next question is to you. So as seen in the presentation also, and we have encountered that typically for the HAM projects that were awarded after March, FY20, because there have been a lot of moderate sponsors who have kind of participated in this, the execution risk seems to have been increased significantly. What are your observations on this whole phenomenon?
Good afternoon, everyone. So, by the participation of a moderate, weak, strong sponsor, I believe that has not led to any, execution challenge. Execution challenges have come up because the complexity of projects have increased. The level of deliverables, the extent to which the level of deliverables have increased, and industry has to move on to it because there is a certain type of network which we have built for a normal highway, and now rightly so we must move to making elevated structures, more tunnels, more complicated highways in more difficult terrains. So the focus has to shift there. Now we cannot simply blame an execution challenge to classifying a sponsor as a weak or a strong or a moderate sponsor. Definitely their financial health becomes a part of the story, and their ability to have the requisite technical expertise or the required skills in their management practices, they definitely form a certain core of the execution issue. But we must also look at it as the type of projects which are coming up and which are being taken up in, I think, the next 2 years or 3 years to come up or after that.
Okay, so you're basically saying that the type of the projects and the complexity is what is the core reason, which is where the execution challenge remains, and not really on the category of the sponsor which is executing. Is
Yes.
that your key message that you're saying?
Yes, because there is enough support through the HAM model. If we are speaking specifically for the HAM model, there is enough support for the financial health wise of any project, and EPC is purely from the financial health of the project. There should not be a concern should anyone be able to deliver the project in a steady manner. So if there are any nascent issues with respect to land acquisition or any environmental clearances, other than that, it's maybe a typical project which requires a certain work in a hilly area, or a certain type of complicated bridge or tunnel, which may require a certain extra time than what has been proposed by the authority initially. That could be one factor. But other than that, I think the categorization of the financial health of the sponsor may not be the only reason by which we can go about as an execution challenge.
Sure, there are multiple shades definitely which attribute to the overall execution risk. So, in fact, extending on the same part, sir, Mr. Mehta, my next question is for you. When we look at the delay in the declaration of appointed dates, and that too beyond 1 year, especially for these are those projects which have been kind of bid out after FY20. And that's a huge sum when we look at the overall figure of BPC of 26,000 crores. Do you expect that there is indeed an increased risk of termination, or these projects are likely to go for rebidding? What are your thoughts on this?
See, I mean, there are two parties to this transaction, NHI and the developer. Now, who's at more of a risk from a perspective of termination? So I think so. From an NHI's perspective, they have already so once they have bid out the project and already invested in some part of the land, and there is some delay in acquiring the other parts of the land. There is a delay in giving the appointed date. NHI generally is not in a mood to terminate the contract. Another point is, in the recent times, what we have seen is, keeping inflation in mind, rebidding is not a good proposal, because then they will end up with a higher price, which may, jeopardize the old price. Definitely, that's NHI definitely wants to ensure the projects are done at an economical price. So I really don't feel that NHI would go the path of termination or rebidding. I don't think so. They've done really anything much on that account. Generally, what happens is they get into discussion with the developer and try to extend and ensure that the developer still continues to complete and take up the project. And from the developer's point of view, okay, fine, he's partially substituted for the increase in timeline because escalation is available. So approximately 60 to 70% of the cost of the escalation is passed through. So there he's a bit protected. I think so from that perspective, I think so termination and rebidding is not really in the near feasibility. I'm sure developers and NHI will find out a way so the projects are completed as soon as the land is made available. I mean, 1 year and the appointed date is made available.
Indeed. So that's the last resort which the regulator may look at, but you don't foresee that happening very soon.
Right.
Or that's unlikely. Mr. Nayak, your views, do you have a similar view, or what are your thoughts on this?
Yeah, I have full this support on that particular view. Another reason I would add to
Sure.
In a bid where it has been this agreement, I mean, LO has been given and appointed date has not been declared, or for some reason it has not been been able to execute it. See, there is a price escalation compensation mechanism built into the system. So from the bid due date, there is a for concessionaire it helps because of two things. Once it is going for rebidding, this price has been open in the market, so everybody knows what is the bid price. Criteria it is there, or what is the amount it is being bidded for. The second thing is that winnability of that particular bid might be very difficult. Today I have a project in my hand with a cost escalation mechanism in place, so no concessionaire would like to give up. And as Mr. Mehta told, similarly, NHA will also not be very keen to terminate the project, because everything has been passed through some certain system, and even if it is terminated by force, then they have a legal recourse available. So in no way it is thought upon that anything will be terminated for that matter.
Understood, sir. So basically, everyone would try to salvage the situation rather than leaving it in the middle of the. Understood. Gaurav, my next question is for you, especially with the increase in bank rates, the trend that has happened, and there is a higher than expected inflation-adjusted BPC cost as well. So automatically, the lucrativeness of the HAM stake sale has increased. At the same time, developer, if we see, they also have an option to unlock or churn their capital, either get through a top-up loan, and because automatically the assets also start becoming high-rated. So how do you see the momentum of stake sale transactions in this context? Because there's an option now opened up for developers. Yeah.
No, absolutely. I think if you look at the market as well, all these options have become competitions for people like us, very clearly. I think anyways, as I just spoke about, there is enough fund space available, fund interest available, where people are willing to buy assets because of these increased bank rates, etc. And also in developers themselves are looking to the InvIT route. And I think I'm sure a lot of my co-panelists would have explored, or they are already in talks to sort of set up their own InvIT. So I think it's a likely route. I think, but just also want to caution in terms of what's been our discussions with various investors. I think clearly, given the fact that when, let's say, somebody from an emerging or from an offshore market looking at India, they're actually looking at growth. They're looking at that alpha versus, let's say, in a developed market like Europe, they don't get such alpha. They're expecting, let's say, a government yield kind of returns. So once they're looking at emerging markets, they want that growth. And unfortunately, HAM doesn't provide that growth. Those kind of growth will possibly come from toll-rated assets. So I think as far as the offshore investors are concerned, you will always find them some sort of more inclined towards a toll-rated portfolio. But given the domestic market, frankly, if you ask me, domestic market, HAM is a great product to be in, because they would then start comparing, let's say, what they get. For example, a person like me who would possibly want to invest in a fixed deposit versus investing in a unit of a HAM portfolio, it frankly makes a lot of empirical sense. But I think, given the fact that even if you have to do an InvIT, you would still need an anchor investor, and that possibly will be a global offshore player. It's a balancing act at the end that someone would have to play, and hence we'll have to see how this plays out. It's a dichotomy. Someone would want growth, which is not there in HAM, but HAM gives you that stability, and hence a balancing act is what somebody would want to look at.
Definitely, because it varies in terms of the risk return expectations.
Just 1 minute, Rajashree.
Sure.
Yeah, I am in some other emergency situation is there, so I have to drop out for a moment.
Okay.
So if there are some specific questions on me, I can just answer, and I drop out.
So basically, I mean, this is really important for you. It's okay. I mean, you can exit. We would have loved to have you through the entire event, but we understand.
Yeah, I am keeping this session alive. If it is possible and still it is continuing, I'll join back.
All right, sir. All right.
Yeah, thank you.
Thank
you so much for coming in. Mr. Agrawal, I have this question coming up next for you in terms of, again, the EBITDA margins or the operating margins of the sponsors who are also developers in the projects. They have gradually reduced over time, especially from 21 to 22. And we expect that while, honestly, the input prices have softened, yet because of the competition which has come through, maybe the margins will still remain range bound. So what are your views in the current year? For FY23, what is your outlook on the operating margins?
So in FY23, we will generally see, projects which have been awarded around, the March 2021, the FY 2021 projects, which we would have announced. So, hence there is an understanding that, the margins will slim, because, the rates which were there at that time are very different from the rates which are existing right now. There was much lower prices of steel and cement, which had a very drastic and unreasonable rise, a rather meteoric rise over the time of bidding, and the price index multiplication does not really account for all that change. So, but the projects which have been bid relatively after, let's say, around after June 21 or after September 21 rather, those projects will see a steady EBITDA. Definitely, comparatively, some people have taken a nosedive. So nobody can speak for those. I can't speak for that. But any reasonable activity is any reasonable bid, they will see steady margins if they are bid after September, because there was a certain normalization and idea of what the steel prices and cement prices were going.
Okay. So effectively, again, this is going to be a mixed bag for depending, how people have bid at what price point, and therefore they expect.
For one more year, or maybe 6 more quarters. After that, you will see a normalization, provided we don't have any unexpected dips or increases the profile.
Yeah, sure. Mr. Mehta, we have seen that, recently, last week, in fact, NHI launched this surety bonds for infra. So as an EPC contractor, do you see this thing would actually result in easing out for your working capital, or is it a far-fetched theory?
No, surety bonds definitely is going to play a good role. I think it will take time for it to mature, for people to start accepting. But we have seen internationally surety bonds given out by insurance companies work very well.
Right.
No doubt there will be formalization of the assessment process of people on whom insurance companies would take risk on. I'm sure their risk appetite is slightly better than banks, and probably so we don't know what exactly regulations they come up with, because our bankers are regulated substantially from a bank guarantee perspective. I'm sure the authorities will not allow insurance company to keep on giving surety bonds left and right. So there will be some system of assessment, but it will be slightly more liberal than banks, insurance companies. So I believe these surety bonds should play a good role. Internationally, it is very well accepted. I think so. We should encourage. Bankers have a limitation on capital adequacy on BGs giving out.
Absolutely.
So I think the replacement and an additional source will help all EPC contractors.
Yeah, absolutely. So in fact, yes, having an additional avenue is always welcome when you're looking at a large infra creation pipeline, and definitely the things will have to pan out, and we'll have to just wait and watch.
Right.
We would be taking up the question answers very soon. Before that, I have one question for Gaurav here. In view of the sizable projects which are awarded to moderate sponsors, especially that how we see, do you see that going forward there's a tactical shift in finalizing deals or entering into deals for projects which are still in under implementation phase? Instead of waiting for them to become operational, do you think that there will be a preponement of the decisions, and deals will start happening at the construction level itself? Because in a way, developers also can start focusing on their execution while sharing the funding risk. Do you see that happening?
No, I think absolutely. I think there's no reason why those things cannot be explored. I think we were chatting before we started this conference, and Hardik mentioned that it's a very symbiotic relationship where we are the capital providers and the developers are execution people on the ground. So I think it makes a lot of sense actually. It's just a win-win composition. But I think at the same time, it is not something that it's in lieu of the financial capability and execution capability of the specific developer in question. I think these are people will be backing only players who have at least have a track record if there is, let's say, a financial mismatch of some sort. Those can be sort of plugged in and those can be solved. But I think someone coming into the under construction phase will want to understand the track record, will want to understand the philosophy, will want to understand the resource capacity of any developer. I think that's point one. The second point is that when you're looking at people, maybe platform companies like ours or similar companies like ours who are actually trying to do something like this, I think what is really important for getting the investors' comfort is to make sure that you develop good team on the ground who can actually then start understanding and measuring these risks and mitigating these risks on the ground. It's very hard for me to believe that someone who's just sort of starting out, with just trying to sort of set up a team to sort of try and operate and maintain roads in the country. It's just very hard for me to sort of fathom that these people also in the near future can actually start getting into these transactions, because these are quite risky deals in my view. There's a learning curve that one needs to go through, in my humble opinion. And hence it is important that not only you look at the developer, but also look at yourselves, whether you would be able to sort of mitigate, manage and measure these risks, and ultimately build that trust between the developer and yourself to be able to ride the curve, ride the wave, as they say, because this is going to be it's not going to be a very simple ride. It's going to be bumpy as well. So hence it's important for you to really understand what kind of risk that you're getting into.
Sure. So what you're saying is essentially this idea is not totally ruled out, but yes, the skill set have to be matched. Both from the developer side, they need to have the right execution and investment philosophy, which will attract the right talent and the investors. So,
Absolutely.
yeah. Okay, great. With this, we come to the end of today's panel discussions. I'll just wait for Maulesh to come through. Maybe he can take over the question answers from the audience.
Dear participants, we would now begin our Q&A session. Request to key in the queries in your panel. Thank you.
So we have received the first question. The first question is from Mr. Mohit from Kotak. So this question is to Gaurav. The question is that what shall be the medium-term outlook for the toll roads, considering the DFC and some of the alternate route construction plan of NHAI?
No, I think the toll road in general, obviously giving a fundamentally general principle is that the traffic in the country will grow with the GDP, the real GDP growth of the country. I think that's where we start. Now, when you talk individually about a particular road, it's just again very hard to say how a road will function unless until you understand the networks around that road, etc. Now, coming particularly to DFC, there is obviously not only DFC but the Delhi-Mumbai Expressway, etc. When I talk about the Western Dedicated Corridor and the Eastern Dedicated Corridor, you have the NH1 that gets impacted. So I think what is important is to really understand which project that we're talking about. The roads between Delhi Mumbai are obviously ripe for disruption because of the DFC and because of Delhi Mumbai Expressway. And that does not only impact, let's say, the NH8, but also NH3, which is the two main routes that are currently used between Delhi and Mumbai. And similar sort of disruption would happen on the Eastern Freight Corridor, wherein the GT road is the main fundamental road that is currently being used. So I think it just becomes very interesting situation for us because we sort of feel that we are in a way pioneers because of the fact that we've been in this sector for the last 8-9 odd years now, and our people who have been associated with us are in the sector for the last 30-35 years. We do have a sense of what is the cost of, let's say, travel between, let's say, point A and point D, point B in any part of the country, and hence it gives us some sort of an advantage, and hence all these sort of disruptive ideas that are getting implemented. Possibly, we think that it is important to look at data, and hence, based on the data, it is possible to have a fair estimate of what can happen, and possibly that gives us some sort of a competitive advantage when we look at roads in the country. So I think I'm not able to answer your question in total because we'll have to look at a specific project and see what are the networks around it, what are the long-term traffic that is associated to that road, what is the captive traffic associated to the road, is there a rail network there, is there a port network that can also come in there. So I think those factors come into the play, but overall we are very positive on traffic growth in the country because of the possibly high GDP growth, relatively speaking, to global levels.
Okay, thank you. So next question is from Mr. P. Padmanabhan. So this question is to Mr. Paresh Mehta. So the question is whether BOT toll project as a business model will find its way again, or it will be a history now.
So I think so. BOT model concentrating the construction risk and the collection risk at one place was typically getting too much from a developer's capacity to hold on to a project. I think so. So BOT model is today still there, but it's split into two parts. One is a EPC model, which is either in a HAM project, or then there's a TOT model. And so TOT model is something which is going to fly, which typically impacts a BOT model. And there could be some projects which would be in BOT, but I think so the TOT model with a HAM or plus EPC model is one of the best. So it really does not change the profile. And then deep-pocketed people who want to invest in TOT with a reasonable assessment of traffic, because now the network has increased so much that the TOT will fly, toll collection contracts will fly, and maybe the BOT model will be very limited, very, very limited. So those developers who have really made deep pockets, probably they will go in for BOT.
So the next question is to Mr. Hardik Agrawal. It is from B. Ravi. So, Mr. Agrawal. Question is that will this a government plan of Bharatmala Phase 1 shall be deferred? And what is the view on execution from 2025 onwards, as there is limited visibility from the government side for the highway sector?
So every country or every geography goes through a phase of construction and then through a phase of operation and maintenance. I strongly believe that our country is going through a very long, expanded phase of construction. I think that there will be a lot of construction projects. There will be a lot of infrastructure capex by the government until at least 2030. After which we should be entering into a strong cycle of asset management and operation asset maintenance, which will be a larger, if not equivalent, business for the infrastructure developers and EPC companies in the country. But definitely, yes, we are seeing the times of technology. So there will be a integration of infrastructure for be it highways, be it city amenities, be it other items. So there will be an integration of projects, integration of different sectors of infrastructure. So, but we will not see just roads be a part of any infrastructure project, but we will see it as a combined ecospace with other city applications and other logistical platforms, which will be integrated with the road. So, a very interesting twist, I believe, our industry is going to take in the next 5-7 years.
So, next question is from Mr. Jimmy. So, this is to Mr. Mehta. So, considering that the weaker sponsor and some of the projects are languishing, the question is that the what are the issues in terms of securing the projects through harmonious substitution route, and what will be the all opportunities in this segment of harmonious substitution of sponsor?
See, weaker sponsors, the challenge will continue to remain. Substitution of the sponsors by a new sponsor, though provided in the documents, is definitely a challenge, because when you are entering into a half-baked project, there is a lot of ambiguity about quantum of construction, value of construction, liabilities.
अरे यार ये तो बड़ी embarrassing situation है यार ये तो
liability from other liabilities hidden in a balance sheet of a sponsor or a project. It's not like a NCLT order where you get a clean check company. It's like it's just the same with the same liabilities which is handed over from one sponsor to another. So I believe the substitution of harmonious substitution will be a challenge. I hope there's a better solution. Otherwise, what will typically happen is projects will be terminated, and probably NHI will end up completing those projects on an EPC mode for the whatever balance project is left out.
Okay, thank you. The next question is from Arita Banerjee. So this is to Mr. Hardik Agrawal. So what is the likelihood of NHI reducing its contribution to 20% in NHI HAM projects, and what will be the impact of the same on the industry?
That's a decision that really NHI has to take. And in policy corridors, lobbies, we have heard this discussion. But at the end of the day, it is a decision that will be taken by the policy makers. Of course, policies are discussed between NHI, all stakeholders, including the concessionaire contractor fraternity. But eventually, it is a decision of the policy makers. And well, I believe that if the conditions of contract are changed, the conditions of estimation by the concessionaire should also change. We will take into account the revised conditions, and accordingly, we will be preparing our bids, preparing our financial analysis and modeling. And I think and competitively, of course, it will have some impact on on the third or the fourth generation of companies, the newer companies which are entering, because they'll have a more difficult, they'll have a little bit more difficult time to catch up. But I don't know if it's happening anytime soon.
So the next question is from Mr. S.K. Rath. So this is to Mr. Nayak. So what is the impact of the annuity and O&M payment in case of de-scoping of the project? So that is the question.
Yeah, thank you. See, as far as descoping is concerned, it has to be seen, see, as far as the quantum of work is to be executed, that plays a very big role here. Might be two situations it may come off. One is that it has to be descoped compulsorily because land is not available. The second thing is that it might have come up in patches where the descoping might not be able to put the road into a traffic mode. So as far as annuity is concerned, there is no fixed rule as far as NHI is following these days. This has been deliberated a lot in between what should be the modalities. So we had, worked out at some point of time 3 or 4 modalities how it should be addressed. Strictly speaking, it should be descoped, and annuities has to be, reduced in a proportionate way. Of course, once it is descoped, there is some weightage of the cost to be, credited to the concessionaire. But what NHI is taking today is a route of delinking. Once it is not descoped, then it is left to the concessionaire to, come with a supplementary agreement telling that this is delinked. We will be paying the annuity in full for the completed projects to the extent it is completed, and balance you have to complete within the same price. So the price will not be escalated. And once it is completed, we will restore the annuities in totality if it is not paid in full. So two options come up. NHI pays in full in case of delinking if it is a smaller quantity. If not, it can be reduced to the reduced proportionately and to be recouped in totality from the date of PCOD till the date of completion. So either way, the concessionaire will not be losing out as far as descoping is concerned.
So we have many questions, but due to paucity of the time, and since we are already exceeding the time, we'll take a last question. So the last question is to Mr. Gaurav. So this is from Mr. Abhinav Sinha from Coral Capital. So the question is to Gaurav. So the question is that considering the reduction in the grant to 20%, so how the investor and FI view this in light of current market scenario?
No, I think this is obviously it increases the capital investment that can happen. I think one of the key concerns with HAM roads has been that you don't get a lot of investment in, and you end up buying a lot of a portfolio of assets. I think if you look at the equity investment per project is not generally it is not more than 150 crores, roughly $20 million, and that's the reason for that is a very high portion of grant that comes in. Obviously, this HAM model was invented or discovered at the time when this was the requirement of the country, when there was a big capital shortfall. And again, kudos to NHAI to come up with that model, wherein they supported the private enterprises to bring down the capital requirement. But now, given the extreme amount of competition that we are seeing on the bidding space, I think it'll be again a win-win where people who are more stronger sponsors who have the visible amount of net worth can come in and sort of bid for these projects, and also increases the capital on a per project basis. So just to give you a sense, if you have, let's say, if you have to invest $200 million, you ultimately end up in a 10 project portfolio and you have to receive 20 annuities in a year. So it's a huge sort of task for any platform company to be able to deliver on that. And hence, if you're able to increase the investment per asset, I think it just sort of also intensifies people like us to, in fact, be a little more positive about the sector.
Okay, thank you. So with this, we have completed the Q&A session. So now I hand over the session to Rajeshri.
Thanks, Maulesh. I think we've had an extremely interesting session today, a lot of question answers, and we've had a very patient panel who've taken up all the queries as well. More importantly, we've got really some clear answers from you all. We all unequally agree that the ambitious NIP plan per se, it requires firing of cylinders from all the quarters. It's not just one party; it's all the stakeholders, including the lenders, contractors, investors, and everybody. And therefore, enabling policies and the implementation are definitely the prerequisites for attracting more and more investments in this sector. So all in all, we believe Indian road sector is definitely holding up steady despite all these manifold challenges. Thank you once again, Gaurav, Mr. Mehta, Mr. Agrawal, and Mr. Nayak. It was indeed a great pleasure to have you on our panel and again patiently answering all the queries that the audience has raised. Thank you to all the participants for taking out time from your busy schedules. It's a quarter end, we all know, and still joining us today. I shall now hand over the session to Mangesh for closing remarks. Wishing everybody on call a very happy and promising new year. Take care and thank you.
Thank you again to all our guest speakers for their insightful views. Mr. Malhotra, Mr. Agarwal, Mr. Mehta, and Mr. Nayak, it was a privilege to host you. And thank you to all participants for the time taken out and being a part of the CareEdge webinar. For any further queries, feedback, and suggestions, please write to us at corp.com@careedge.in. Goodbye for now. I request the tech team to log off.